from the White House, in particular on drugs. In Syria, 100% levy is massive, but there's going to be carve-outs for companies that have manufacturing in the United States. And a lot of them have said, we're going to build stuff, going to build facilities in America. Let's get more from Clark Geranen, Chief Market Strategist at Calbay Investments. Thanks very much indeed for joining us.
Thanks for having me.
Fresh tariffs, but investors don't seem too disconcerted right now.
No, really, the markets are primed for growth. Despite all of the potential headwinds, the markets have been brushing those off and really focusing on the tailwinds that we thought we had at the beginning of the year. And so we really have these rams pushing us forward, and that's rate cuts, AI integration, merger activity, and strong corporate earnings, not to mention the latest GDP numbers, which showed that the economy is even stronger than we thought.
Right, so you had that acronym for us: RAMS, rate cuts, AI integration, mergers, and strong corporate earnings. Talk to us about AI. I know it's a subject we've been maybe exhausting, but it's such a huge story, isn't it? The concern that there's overbuilding going on.
And I think that's the main point that I'd like to make, is that many of the stories that you hear out there are all from the negative perspective. And so we've really been viewing that from a contrarian perspective, looking at it from that's usually when you have one of the better opportunities, and just seeing how much AI has been integrated in not only companies, but in some of our daily lives. AI has reached American households and households across the world faster than both internet and TV. Mm-hmm. And so, I mean, we really do equate this to, mid-90s investing in the internet.
Before things went bad, or before things got too overheated, you mean?
Exactly. So we're still in the early stages of that. And if you were to think about it, if you were to invest in some of the early internet companies over the long period, mm-hmm. that played out very well.
Yeah, that's right. If you avoided the ones that, lacked earnings, for example. Yeah. What about more conservative areas of the market, real estate or the rate sensitives? I know electricity utilities, that's been distorted because of euphoria over the power demand for AI, but generally interest rate sensitives, are you seeing opportunities there?
We do. So specifically financials is where we feel bullish right now. Mm-hmm. Not only with the mergers and acquisitions, but rate cuts, they've been handling that well. And over the past few years, even as rates increased and banks were squeezed a little bit, they still have continued to perform well. And, I think one could even say that there's an AI play within financials too.
What about more rate cuts? Say the Fed doesn't deliver. Say they go super cautious. Of course, President Trump wouldn't like that. Could that be a roadblock for the market? Could it cause a drop in stocks if the Fed suddenly stops cutting interest rates again?
No, I don't think so. And from our perspective, we don't really think that the markets need another rate cut. So we're only predicting one more for the rest of the year. And really that has to do with the inflation numbers. Like we got new inflation data this morning, which came in line. And that was one of the main concerns, was if we did start to see this rise in inflation. The other part of that is the unemployment numbers. And while we have seen them start to tick up, it seems like it's been more of an issue with hiring and/or efficiencies, not necessarily related to a slowdown in the economy. And so as we've seen the GDP number get revised up and we've seen inflation stay in check, unemployment has not been out of this realm, we really do feel that the economy is doing well, as well as the consumer. Consumer spending was up from last month. And as long as we're able to see that consumer spender, which makes up 2/3 of our GDP, then I think we're going to continue moving forward strongly without needing the rate cuts.
Gold, are you tempted to just have an insurance policy in the shape of small holdings in gold right now?
Absolutely. I mean, gold and silver have had quite a run up so far this year. And so, depending on the investor, I think can be a helpful play. Right now, many analysts have targets of 4,000 by the end of the year and 5,000 by the end of next year. And it really is, I think, a destination for people with cash that have been in the short-term interest rate products like CDs and money market. I think we're going to see that go in two different directions. One, maybe more to the traditional equity market, but two, flowing over towards gold, commodities, and Bitcoin, for example.
We are. It looks like we're going to get a whole bunch of new IPOs, many connected with AI, and perhaps some connected with the power industry, the electricity industry. You say you're reminding investors you don't have to chase every flashy new thing.
No, and I think that's the one warning with AI. We have some established companies, but we also have some of these brand new companies that are IPOing. And so that's been a big part of the markets this year, are all of the new companies that have gone public. And I think just investors need to realize that many of these companies might not be around in 5 years. So like we were talking about with the internet and TV in the late 90s, a lot of those companies did get flushed out. And so that's why there does need to be caution when investing and make sure that it fits your risk profile and you're not going above your skis.
We'd better jump. Clark, thank you very much indeed. Clark Geranen, helping us out there, Chief Market Strategist at Calbay Investment.